Assalamualaikum listeners, welcome back. Today I'm here to discuss the exercises of corporations. We have talked about, or we discussed in the previous recording regarding the corporations, their formation, and their capital stock transactions. When we discussed the capital stock transactions, at that time we have discussed about common stock, then we talked about preferred stock. We also have taken into consideration the treasury shares, and we also saw the effects of all these types of stocks on the owner's equity section of the balance sheet. So, in continuation to that discussion, now we're going to solve some of the exercises relevant to these topics. So, I have chosen some of the exercises starting from exercise number 13-3. So, let's go through this and try to solve it together. During its first year of operations, Foyle Corporation had the following transactions pertaining to its common stock. January 10, it issued 70,000 shares for cash at $5 per share, and July 1, it issued 40,000 shares for cash at $7 per share. Journalize. Now, what we're supposed to do, we are going to journalize. Journalize the transactions, assuming that common stock has a par value of $5 per share. So, when we were discussing the topics in the chapter, we have clearly understood this that common stock, preferred stock are always recorded at their par value or stated value. So, in this transaction, the detail which is January 10, they have given us the sale price for the shares or issuance price of the shares, but they have not provided us what is the par value. That's why in part A they are saying that the par value is $5 per share. So by selling 70,000 shares, company gets $5 for each share cash. So how much total cash company got? 70,000 multiplied by 5, so it is $350,000. And then company has issued common stock. So when we talk about common stock, if you see the issue price is $5 and the par value is also $5. So basically common stock is always recorded at par value, okay? So par value was 570,000 multiplied by 5, that is 350,000. So we don't have any excess in this uh, journal entry. Why? Because whatever was the par value, the same was the issuance price of the stock. Moving on towards the second transaction in part A, that is July 1st, it issued 40,000 shares and $7 was the per share price. So it means the issue price is $7, but the par value is $5. So how much extra we are charging from the stockholders? So $2 extra, $2 excess we are charging for each share, right? So let's try to record this transaction. 40,000 shares were issued. For each share, company has charged $7, so 280,000. At the same time, common stock increased because of these 40,000 shares. As I mentioned few minutes back that the common stock and preferred stock both are recorded at par. So par value is $5. So 40,000 shares multiplied by 5, that is 200,000. How much excess we are charging for each share? $2. So how many shares were there? 40,000 shares were there. So 40,000 multiplied by 2, 80,000 excess. Which account we use? Additional paid in capital account is used. So paid in capital in excess of par, because these are common stock transactions. So we will be writing here particularly common stock. If it will be preferred stock, you have to write here preferred stock. Moving on towards part B, do remember that in part B, the par value we don't have, we have stated value. But stated value serve in accounting journal entries exactly like par value, and that is $1. And we have to record both transactions again by considering that the stated value is $1. So in the first part, when the company issued 70,000 shares, issue price is 5, but the stated value is 1 now. Okay, so let's do this transaction. Cash cash gets debit, 70,000 shares are being issued, and 5 is the par value, 5 is the issue price, so 350,000. Common stock get credit. Now we have stated value, that is $1, so 70,000 multiplied by 1. So let's compare again. Issue price is $5, but the stated value is $1. So how much excess? $4 excess. Okay. So common stock gets credit because of $1 stated value. Now excess paid in capital in excess of. Don't write here par value. We have stated value. So stated value. Common stock. How much was excess? $4 for each share. So that is 280,000. Moving on towards the part B, part means July 1st, we have 40,000 shares and the $7 is the issue price. To remember, stated value is $1. So let's move on. July 1st, and cash gets debit. Issue price was $7, 40,000 shares, so 280,000. Now, issue price is $7, but the stated value is $1. So how much excess? $6 is excess. Okay, so common stock gets credit because of stated value $1 each year. So that comes up 40,000. Excess was $6, so 40,000 shares each year give an excess of $6. So paid in capital in excess of stated value common stock, that is 240,000. Let's move on towards exercise number 13-4. Osaka Corporation issued 2,000 shares of stock. Now, let's see which type of stock, what's the par value, what's the issue price. All these details are given in following parts. Prepare the entry of the issuance under the following assumptions. So we will record the journal entries for this stock issuance of 2,000 shares by looking into each and every transaction out of these 5 following transactions. And we have to entry means journal entry. Number 1, Part A. The stock had a par value of $5 and was issued for a total of 52,000. They didn't give us issue price per share, but yes, they told us that the issue price for total 2,000 shares was 52,000. So company gets the cash. How much cash? 2,000 shares they sold and issued, and the sale price they did not give us for each. I cannot do it individually. I can write the full price, which is 52,000. So I'm going to remove this component because I don't have individual sale price. If I would have, I will multiply and write it. Common stock gets credit. Common stock is always recorded at par. So 2,000 shares par value is 5. So that is 10,000. So it means we are charging them extra. Extra how much? 42,000. So paid in capital in excess of par common stock. I cannot calculate excess value per dollar like I did in the previous question because I don't have the sale price or issue price per dollar. But I can find out the excess by looking into the difference on the par value of the common stock and the issue value full. So difference is because of excess you are charging. Part B says that stock had a stated value of $5 and was issued for 52,000. We will do the same journal entry, but instead of writing par value, I'll be writing stated value, and that's the only difference in Part B. So can you see here? Cash gets debit, 52,000 we get all together. Common stock get credit because of the stated value 2,000 shares multiplied by $5, that is 10,000. Difference is because of excess amount you are charging, and so this is paid in capital in excess of stated value. Don't put this hyphen, it's by mistake. So paid in capital in excess of stated value hyphen common stock. Moving on towards Part C. Part C says that the stock had no par or stated value. So when there is no par or stated value, common stock is credited exactly whatever you are getting by issuing these shares. Okay, the stock had no par, no stated value, and was issued for a total of 52,000. So this is the case. How are we going to do that? Cash we get, that is 52,000. And common stock gets credit 52,000. Fourth part says that, part number D says that Stock had a par value of $5 per share and was issued to the attorney for services during incorporation. So during the incorporation stage of company, the attorney has provided the services. Of course, for that those services, they must have built the company, and they say that the amount is 52,000. And company issued the shares to this attorney for the bill they sent us. Now, the bill they sent us, they are the organizational expenses for the company, and company, instead of paying the cash, they issue the shares of $5 per share. So let's record this journal entry. We have organizational expenses bill 52,000. So we made it debit, and we issued common stock. Again, common stock will be recorded with par. So $5 is the par value, so 10,000. How much excess was there? That will be paid in capital in excess of par common stock. Again, remove this hyphen. 42,000. Finally, part E. The stock had a par value of $5 per share and was issued for land worth 52,000. Now, for this, we studied that if you acquire a non-cash asset by issuing the shares, you don't get cash, you get non-cash asset. Then we have to compare the fair value or the market value of consideration received. What is consideration received? You are receiving a non-cash asset, or consideration given up. What you are giving the shares. So basically, you have to share the fair value or the market value of consideration given up or consideration received, whichever is more clear. Okay, this company, if you see this company, fifth transaction, they did not give us any fair value of the consideration given up, so we don't have this. But they said that the land worth 52,000, so consideration received fair value is more clear. So we will debit the asset, which is land, with the fair value of consideration received. Okay, so if you see over here in fifth transaction, we have debited the land with 52,000. Common stock gets credited. 2,000 shares were there. $5 was the par value. So when I multiplied, that is 10,000. Difference is because of excess, that is 42,000. So in this question, we have shared all the scenarios in which you issue the common stock at par, you issue the common stock at stated value, you issue the common stock for organizational expenses, and you also issued the common stock for non-cash expense, non-cash assets. Okay. Let's move on towards next exercise, which is exercise number 13-5. Quick Corporation has the following transaction during the current period. I'll be reading these transactions in a while. Let's see what we are supposed to do. We are supposed to journalize these transactions. So let's do them. March 2nd, this is March 2nd, issued 5,000 shares of $5 par value common stock. Okay, 5,000 shares are issued par value of $5 to the attorney in the payment for the bill 30,000 for services performed in helping the company to incorporate. So this is exactly what we did few minutes back. Organizational expenses of 30,000, and we issued the shares of 5,000 shares, $5 par value. So let's record this journal entry. Organizational expenses gets debit. Common stock gets credit. It will always be recorded with its par value, that is $5. So 25,000. Extra amount is paid in capital in excess of par common stock. Moving on towards June 12th, issued 60,000 shares of $5 par value common stock for cash of 375,000. They did not tell us what per share cash, but yes, they gave us the full amount of 375,000. So let's record this journal entry. We get the cash of 375,000. Common stock gets credit with par, so 60,000 share par is $5, so 300,000. Extra amount is paid in capital in excess of par, 75,000. Moving on towards July 11 transaction, issued 1,000 shares of $100 par value. 100 is the par value, 1,000 shares, preferred stock for cash at 110 per share. So 100 is the par value. You are charging 110 per share. So excess amount you are charging, that is $10 per share. Let's record this journal entry. So 1000 shares are issued. So cash gets debit, 1000 shares multiplied by 110, that is 110,000. Preferred stock gets credited with par, just like common stock. So 1000 shares, 100 is the par value, so that is 100,000. And excess was $10. You can take a difference, but you can also multiply 1000 with 10, which is excess, that is 10,000. Finally, November 28, company has purchased 2,000 shares of treasury stock for $80,000. Now, when I discussed the topic of treasury shares, I told you that for treasury shares, whatever is the purchase price, that serves like a cost. That serves like a par value for the state treasury shares. Okay, so this is the amount you get, and of course, you would have given this money to the shareholders to get back your 2,000 shares. So on November 28, treasury stock gets debited with 80,000 and you have paid cash of 80,000 to the stockholders. I hope these transactions are clear to you. Let's move on towards exercise number 13-3. This exercise is going to discuss something really important, which is about purchasing or paying shares, giving the shares for some non-cash transactions. Okay, so let's see this transaction. As an auditor for a CPA firm of Hinkson and Calvert, you encounter the following situation is auditing different clients. So you have two different clients, and for them you have noticed these two situations. Number one, LR Corporation is closely held corporation. Closely held means, what did we study? It's a private company whose stock is not publicly traded. Of course, it's a private company. On December 5th, the corporation acquired land. So this company has purchased a non-cash asset, land, by issuing 5,000 shares of its 20 par value common stock. So they have purchased 5,000 shares. They have given, 5,000 shares for this land, and the par value was $20. The owner's asking price for the land is 120,000. Now asking price, advertised price, they both are almost a similar thing. We can negotiate on these prices, right? But they are also telling us something else, and the fair value of the land is 110,000. Now, what did we study? For the non-cash shares issuance, to record the asset, which is non-cash asset, we debit the asset with the fair value of consideration given up or the fair value of consideration received. Consideration given up is share, consideration received is land. In this example, the company is a private company, so we don't have the fair value of this company. But yes, we do have the fair value of land. It's clearly stated 110,000. So we'll debit the land with this amount. Okay. They want us basically to journalize the above situation. So since we discussed situation number one, so let's journalize it. We will debit the land with 110,000, which is the fair value of the land, and common stock gets credit 5,000 shares, par value is 20, that is 100,000, and remaining is excess. So paid in capital in excess of par common stock. Let's discuss transaction number two. Vera Corporation is a publicly held corporation, so we can find its shares market value or fair value, whose common stock is traded on the securities market. On June 1st, it acquired land by issuing 20,000 shares of its $10 par value stock. At the time of exchange means when they exchange these shares to purchase the land. At that time, the land was advertised for sale for 250,000, and the stock was selling at $11 per share. Now the rule is consideration given up or consideration received, whoever's fair value is more evident. $11 is the fair value of stock, because this is the consideration you are giving, but we don't have a fair value. We have advertised value, which is negotiable. So we don't have a fair value of land. So we will record the asset with the fair value of consideration given up. In the previous case, we have recorded the land with its fair value because the consideration given up fair value was not there, right? Now the land will be, in this case, land will be recorded with the fair value of consideration given up because land's fair value is not given. Okay, so land gets debit, 20,000 shares are issued, fair value of the share is 11, so 220,000. Common stock gets credit with its par value, which is $10, 200,000, and the difference goes to paid in capital in excess of par common stock. Uh, Listeners, as I mentioned before, please don't take this hyphen. This is by mistake. This is because I copy pasted, so that's why it is repeated again and again. Hyphen is here after the par or stated value before we mention the type of the stock. Okay, let's move on towards our next question, which is exercise number 13-7. On January 1st, 2017, the stockholders' equity section of Newlin Corporation shows the common stock $5 par value $1,500,000, paid in capital in excess of par $1 million, and retained earnings $1,200,000. During the year, the following treasury stock transaction occurred. On March 1st, purchased 50,000 shares for cash at $15 per share. So you have purchased back the treasury shares. Then July 1st sold 10,000 treasury shares for cash $17. What was the cost? $15. What is the issue price? $17. So it is above cost case. September 1st sold 8,000 shares treasury stock for cash $14 per share. What was cost? 15. What is the issue price? 14. So it's below cost case. To analyze the treasury stock transaction. Okay. Um, Now we will do this, then we will come back to part B. Firstly, purchase 50,000 shares. The cash value you gave, that is $15 per share. So treasury stock gets debit. 50,000 shares you purchased, $15 paid for every share. So 760,000 treasury stock full cost. Cash gets credit 750,000. Then July 1st sold 10,000 shares and the value was $17, which is above cost case. So cash gets debit, $17 you are getting for 10,000 shares, that is 170,000. The cost of treasury stock become its serves like its par value. So treasury stock will be recorded at par when you will issue it. So 10,000 shares multiplied by 15, that is 150,000. 17 was the issue price, but the purchase price was 15, so $2 extra you are charging. So that is paid in capital from treasury stock, that is 20,000. How come I get it? 10,000 shares were issued at $2 extra for each share, that is 20,000. Do remember this is paid in capital from treasury stock and it is the part of additional paid in capital in owner's equity section. Okay, September 1st, what is happening? You are issuing 8,000 shares and issue price is $14 per share, which is below cost. So let's move on. Now, when I discussed the chapter with you at that time, I mentioned that paid in capital from treasury stock has a normal balance of credit and we cannot debit it beyond its normal balance. So here the normal balance because of the journal entry number 2 is 20,000. Okay, we can debit it only up to what balance we have in the account. Now let's talk about journal entry number 3, which is on September 1st when you are selling the treasury stock below cost. 8,000 shares are sold and the sale price you charge, that is $14. So you get a cash of 112,000. Treasury stock gets credit with its cost, that is 120,000. So how much shortage you have? See here, 15 was the cost, but the issue price is 14. So $1 shortage, or you can say less price you charge for each year. 8,000 shares were issued again, and the less price is 1 for each. So 8,000 gets debit. we have 8,000 in the paid in capital account? Yes, we have. We have actually 20,000. So we can debit it. For example, this debit amount is 28,000. For example, can we debit? No, we can only debit up to 20,000, and the remaining 8,000 will go to the treasury share. Sorry, retained earnings. Okay, but in this case, we have 8,000, so that's why we are debiting paid in capital from treasury stock account. Let's read the part B before we solve it. They say restate September 1st entry assuming that treasury stock were sold at $12 per share. What happened on September 1st? You sold 8,000 shares and they say now the sale price is $12. Let's do it. Sale price is $12 but the purchase price was 15, right? So how much shortage you have for each share? $3. Let's record this journal entry. 8,000 shares are sold or issued with $12 price. 96,000 gets debit. Treasury stock gets credit. 8,000 share. The cost or is 120,000. How much shortage we have? We have a shortage of 24,000 on the debit side. But if you remember in T account, we have because of journal entry number 2, only 20,000 credit balance. So I cannot debit it with 24,000. I can debit it only with 20,000. So I debited paid in capital from treasury stock with 20,000. I still have a shortage of 4,000. So I will debit retained earning with this 4,000. I hope now the treasury stock transactions are clear. Let's move on towards the next exercise, which is exercise number 13-8. Reinhardt Corporation purchased from its stockholder 5,000 shares of its own previously issued for 225,000. So they have repurchased. Repurchased or purchased is always treasury stock. So they have purchased back treasury shares, 5,000 shares, and the price they paid that is 255,000. So treasury stock gets debit and cash gets credit. Remember from this, they did not tell us the purchase price of per share. They just tell us the full value. Okay. Then what happened? It later resold 2,000 shares for $54 per share, and then 2,000 more shares for $49 per share, and finally 1,000 shares for $43 per share. That was 5,000. Then they issued 2,000, so it becomes 3,000. Then again reissued 2,000, so it becomes 1,000. And finally it reissued 1,000, so there is nothing, right? Okay, when they purchased, what was the purchase price? We have the full purchase price, but we don't have per share purchase price. We can calculate because we have number of shares. So what is purchase price? Purchase price is full cost you paid, which is 255,000 for 5,000 shares. So $51 is the per share purchase price. When you reissued 2,000 shares, you reissued them, sorry, these 2,000 shares, you reissued them at 54 per share. 54. So this is above cost sale, right? Then again you sold 2,000 shares and 49 per share you charged. So 49. This is below cost because cost was 51 per share. Then again you reissued 49 shares and sorry 1,000 shares for 43 per share. 43. Again this is below cost, right? So let's record all these journal entries for issuance. 5,000 shares, firstly 2,000 shares you reissued. The issue price they set 54, and for the second reissuance it's 49. Okay, let's do this. When you reissue for 54, cash gets debit. 2,000 shares reissued 54, that is 104,000. Treasury stock cost becomes its par value, so treasury stock will be credited with its cost 51 per share, that is 102,000. How much excess you are charging? See, 51 was the cost, 54 is the issue price, so $3 extra for each. So 2,000 shares, that comes up 6,000. As soon as you get first time paid in capital, you make a T account. It's mandatory. So paid in capital, from treasury stock has now first time a credit balance of 6,000. Then, second time you reissue the shares, 2,000 shares for $49. But first the cost 51, reissuance is 49, so you have a shortage of $2. Anyways, cash gets debit 2,000 shares 49, that is 98,000. Treasury stock with its cost gets credit 102,000. 51 was the cost, 2,000 was the shares. How much shortage? $2 per share. 2,000 shares were reissued and $2. How much amount we need? 4,000. Before debiting paid in capital check, do you have balance on the credit side to debit it? Yes, we have 6,000, but we need only 4,000. So we can debit it. Immediately update the balance. Now we have credit balance of 2,000. Anyways, for second transaction, I have second sale transaction, I have debited paid in capital with 4,000 because I had balance. Moving on towards third sale in which you have sold the treasury share for 43, but basically the issuance price was the purchase price was 51. So how much shortage you have? You have $8 shortage for each share. Okay, now 1,000 shares are reissued, 43,000 cash you get because 43 was the sale price. Treasury share gets credit 1,000 shares with its cost, that is 51,000. The shortage is $8. $8 means multiplied by 1,000, we need 8,000. Do we have 8,000? We have only 2,000, so we can debit paid in capital with 2,000, not more than that. So when we debited paid in capital from treasury stock with 2,000, we still have a shortage on the debit side with 6,000. So that will be deduced from the retained earnings. Okay. Moving on towards the next question, which is exercise number 11-1, 13-11. The following stockholders' equity account arranged alphabetically are in the ledgers of Udemy Corporations at December 31st, 2017. Common stock $5 stated value $1,500,000. Paid in capital in excess of par preferred stock 280,000. Paid in capital in excess of stated value common stock 900,000. Preferred stock 8% $100 par value 500,000. This is also in dollars. Retained earnings 1,234,000. Treasury stock 10,000 shares are there $120,000. They want us to prepare a stockholders equity section. We know that when we prepare the stockholders equity section, preferred stock is always mentioned first, then the common stock, then the treasury share. We also know that stockholders' equity in the companies has two main accounts. One is paid in capital and the other one is retained earnings. And we also know that paid in capital has two sub-accounts, that is capital stock and additional paid in capital. So let's draft the corporation balance sheet, Udemy Corporation, partial balance sheet or balance sheet, and you can write in the bracket partial. December 31st, 2017. Stockholders equity section only we have to prepare because we don't have the other sections details. I will first put paid in capital and the retained earnings, drag it ahead here. In the paid in capital, I have capital stock and additional paid in capital. In capital stock, mention the preferred stock first. So how do you mention it? 8% preferred stock $100 par value. We are not given the information of authorized shares. If we have authorized shares, we will be writing them. But they did not provided us any authorized shares, so we'll be talking about issued and outstanding shares. Also, they did not give us the number of issued shares, they just told us what is the total preferred stock. So we can calculate this is the total value of the preferred stock, but we know the par value of the preferred stock is $100. So 5,000 shares. Okay, so 5,000 shares issued and outstanding. Then common stock, there are no par because they have stated value $5. Again, for the common stock, we can calculate the number of shares issued and outstanding. Firstly, we will calculate issued because if you remember when I read the statement, we have treasury shares. It means that issued shares will be different than outstanding shares. But let's first calculate the issued stock. So common stock issued full amount is 1,500,000, but the stated value is 5. So 300,000 shares are issued. 300,000 shares issued. The treasury shares we mentioned, if you see, there are 10,000 treasury shares. So it means that our outstanding shares will be issued shares minus treasury shares. So we get remaining as outstanding shares, which is 290,000 outstanding. And this amount, I always say this represents issued, not the outstanding. Okay, so total capital stock is 2 million. Then move on towards the additional paid in capital. Firstly, preferred stock in excess of par preferred stock, it was given. In excess of stated value common stock, it's given. We don't have premium account for treasury share in the question. Total additional paid in capital is 1,180,000. So total paid in capital is 3,180,000. Then comes retained earnings. It's given in the question 1,234,000. So total paid in capital and retained earnings are 4,414,000. Then comes the contra equity account, which is treasury stock. So less treasury stock, 10,000 shares. Its cost was also given 120,000. So remaining is my stockholders equity section total. I still have three problem exercises to solve, but just because of the huge size of the recording, I'm going to cut the recording over here, and please listen to the next recording for the second part of the exercises for chapter number 13.